Welcome to the latest edition of Fundamentals. This time around, I'm going to look at a so-called passive fund, namely iShares Core MSCI Emerging Markets IMI ETF. This is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and deliver that performance minus any running costs. In this case, the ETF is tracking an index which has the very specific name of MSCI Emerging Markets Investable Market Index. That's what the IMI in the name means. The benchmark covers large, mid and small caps across 23 countries, and the tracker covers just over 1,900 of the near 2,600 firms within it. It targets stocks and markets which are liquid and investable and whose performance is easy to replicate. iShares Core MSCI Emerging Markets IMI uses physical or direct replication to generate performance, so it owns the underlying securities. The top 5 holdings, as I sit here, are Chinese internet phenomenon Tencent, Korean tech giant Samsung, Taiwanese silicon chip maker TSMC, Alibaba, another Chinese internet player, and South African internet and media group Naspers. By country, China is the largest exposure at 26.7% of the portfolio, followed quickly by Korea, Taiwan, India and South Africa. They come to about 70% of the assets between them, that quintet, as we can see here. Note that after the June MSCI index review, that weighting towards China is going to creep up a little bit, owing to the decision to include domestically quoted A shares and not just Hong Kong or US listed Chinese equities. By sector, as you've already probably guessed, technology is the biggest weighting at just under a quarter of the assets, followed by financial services and consumer discretionary. Utilities, healthcare and telecom are the 3 smallest sector positions, so the underlying growth may be better suited to growth-oriented clients and advisors rather than those who are looking for yield or defensive steady stocks. The tracker comes with an ongoing charge figure of just 0.25% a year, so it is very cost effective. According to data from Morningstar, only 2 trackers out of a field of 47 are cheaper. The iShares product is around £4.7 billion in assets under administration, so it should be pretty liquid, at least under normal market conditions. This particular instrument comes with accumulation units, so anyone buying will have any dividend payments automatically reinvested for them, and this is the dollar-priced option. There are also available a sterling-priced option for advisors and clients as well. The tracker is just over 3 years old and comes with a 3-star ranking from Morningstar for those who place importance in such things. Now, those are therefore the mechanics. The next question is, why would advisors and clients consider this ETF for their portfolio today? And I think there are 3 factors to consider. First, some may fancy looking beyond the UK, given the uncertainty over Brexit, the volatile political situation, and the sluggish economic growth which the UK is currently struggling to shrug off. Second, emerging markets are doing well. They were out of fashion for a big part of this decade, but have come roaring back in the last 12 to 18 months. Generally, emerging market countries have less debt than we have in the West, economic growth is quicker than we're generating here, and companies are becoming more shareholder aware. The chart here shows how the MSCI Emerging Market Equity Index has beaten its Frontier and G7 equivalents over the past year in sterling terms. Third, emerging markets offer exposure to sectors which are harder to access via the UK or some other markets. If advisors and clients like the growth potential offered by the internet and tech stocks, then emerging markets may be a better option for them than the UK or Europe, for example. This final chart shows how the ETF has performed since launch, but none of this to say the instrument would necessarily suit everyone, as there are at least 3 clear risks. First, as already flagged, this is not a product that's likely to appeal to income seekers or indeed risk-averse clients and advisors. Remember, there's an old joke that says emerging markets are called emerging markets because they're very difficult to emerge from when something goes wrong. Second, having primed its economy with fiscal and monetary stimulus in 2016, China is currently tightening policy, so its own property market and economy don't boil over. Any big slowdown in China would be a potential problem for a quarter of the underlying stocks tracked by this ETF. And finally, tech stocks have been flavour of the month for quite a long time now, and as a result, the valuations attached to some internet stocks are frankly pretty racy, and there's very little margin for error if anything goes wrong. Note how some of the big US names have wobbled a little bit of late, and this may help to explain also why Asian stocks have actually just hit a bump as well, stumbling to a 5 or 6 week low. So in summary, advisors and clients need to do their research so they can judge whether iShares Core MSCI Emerging Markets IMI ETF ultimately fits with their own specific strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.